Hello and welcome everyone to Refinitive's Carbon Market webinar, Crunch Time for European Carbon. I'm Anders Nording and I'll be your moderator during the presentation and during the, the panel discussion. Much has happened in the European carbon market in terms of policy, price developments since we had our last webinar, I think in September last year. And we are very excited to take stock and discuss where the market is heading these days. Today we are joined by two distinguished experts. We have Ingo Ramming from Banco Bilbao, BBVA, and Nick Karamidas of Mitteljaneos Aluminium. So they will comment on perspectives from their respective industries. But very first, I'll take you through some quick housekeeping points. You'll see it also on the slide, I think. So at the bottom of the screen, you will see a toolbar. You can use that to access applications such as the speaker biographies, technical support, and resources. If you click on it, it should open on your screen. Then please submit questions. There is an area for that, I think on the lower right hand, at least on my screen. We'll try to answer a few questions at the end of this session. And if not, we'll try to get back to you bilaterally if we don't find time to take them in plenary. And also important, there will be a quick pop-up survey at the end. So please give us your feedback there. We are very eager to hear what you think of the webinar. So we are right now in a very special situation. There is an ongoing reform process of the whole ETS and other policy instruments. Adding on that, there is a war in Ukraine, sanctions, crazy high energy prices. For a long time, the EU ETS review seemed to be going quite smoothly, except for a couple of controversial points, such as the free allocation versus CBAM. That was one discussion. Another one was the opposition to the proposed second ETS for road transport. But then in mid-May, two new ideas emerged to dominate the ETS reform discussion. You had the ENVI proposal, actually coming from the industry committee originally, to ban financials from holding accounts in the union registry. And then, as part of the Repower EU strategy, the Commission proposed to sell EUAs from the MSR to help finance that strategy. And that the two things have, to quite an extent, dominated the debate since then. So to help set the scene now, I'm happy to hand over to my colleague Ingvild Sørhus. She's lead carbon market analyst here at Refinitiv Carbon Market Research. So she'll take you through setting the scene, where we see things moving, and then afterwards we'll have comments from Nick and Ingo, and then we'll gradually move into a panel discussion. So with that, I turn over to you, Ingvild.
Thank you, Anders. So I'll skip then the agenda. You have been through the agenda. So I will, before we start the panel discussion, I will have a quick look on where we are now, a bit snapshot of the UTS at the moment. This year I'm limiting the price only to this year, but the price so far this year, the EUA price, have been quite a bumpy ride, I would say. We're starting the year recording new record highs, where we're getting like closer and closer to 100, and I guess the people in the market were betting on when would prices reach 100 more than when would price reach 55. But then with the Russian invasion of Ukraine, we saw that the energy complex were spiraling upwards, but the carbon market was moving in the completely opposite direction, and then prices were kind of plummeting to 55 within a few trading sessions. I mean, there were several reasons of why we saw this. This was unfolding. some possibly also kind of had to kind of cover losses in the energy complex, had to get out of carbon market. Of course, investors investors so maybe kind of also that the need of that the exposure to European assets as such was more risky, leaving also the carbon market, and possibly some industrials also had to kind of sell some of the free allocation, moving out of the market. But I would say that carbon prices, I mean, they dipped to 55. There were also some kind of seeing some rumors saying, well, the carbon policy or climate policy is now going to be in the back seat. No one really pay attention to climate policy. EUTS will be suspended. Such kind of rumors that kind of amplified this snowballing effect when people were trying to kind of explain why prices were dropping to the degree they did at the moment. But then we hit 55, and then in few trading sessions later, we kind of prices recovered, and when gas prices were kind of moving quite or it saw quite big movements, the carbon price for quite some time just stayed relatively range bound within kind of a 75 to 82 range for a while before breaking out of this sideway range. And I think we kind of also recently have seen that policy is taking more kind of or the market is taking more direction also from the policy what's happening on the policy side. I mean, we have the NV vote rumors or kind of a statement ahead of the vote. We kind of saw that the increased ambition for the EUTS or increased burden on ETS would get support, or was likely to get support. We saw kind of some limiting of positions. So with this statement ahead of the vote also kind of gave quite a lot of intraday movements to prices. So then we had the NV vote, and then the day after we saw the Repower EU plan, which I will kind of comment on, will show in a bit later slide, but that also took market by surprise. So these policy events, I mean, it's natural when we're kind of progressing, the policy files are progressing, that we see these things are taking more kind of the center stage than they have for a long time now. But this year, I mean, looking at the fundamental picture, I mean, we see power sector emissions, they are set to rise further this year. Last year, we saw kind of increase in power sector emissions of roughly 11%. And then we see kind of this is continuing further than set to rise 4% year on year. Of course, last year we saw kind of at least in the second half of the year that there were little room for more fuel switching, and that's kind of continuing this year with the tight gas market that we see no additional gas for additional demand from the power sector. So really we see no kind of really much fuel switching taking place this year. So the chart is showing the CO2 switching price for 36% efficient coal plants to 50% efficient gas plants. So the blue line is showing the EUA price, and for the switch from coal to gas, the EUA price needs to be above the green line. So when the EUA price is above the green line, you would get a switch from that gas plants is more profitable than the coal plants. And we see for the forward curve is really kind of, we have to go all the way to Cal 25, so end of 2024, before we really see that fuel switching is kicking in again. And of course, that's kind of connected with the elevated gas prices, and that they stay kind of elevated, or fuel prices stay elevated for this year and also for next year. Of course, on the policy scene, it's kind of supply or security of energy supply is key. So we also see kind of more willingness to bring kind of decommissioned coal plants back, also to kind of opening up to delay coal phase out plan to avoid or to secure the energy supply. Of course, we see also kind of with the revision or kind of the worsening economic outlook for Europe with the revision down of GDP, we see kind of that's hitting electricity demand, but still we see 4% year increase in power sector emissions. Of course, to the downside, we could see worsening economic outlook that could take electricity demand even further down. And then, of course, are we getting into winter where we need to have forced demand disruption from the electricity sector that could also take down power sector emissions. And then when things are difficult, it would be nice to help get some help from your low emission friends. But we see that we have a year where like the French nuclear availability is at like multi-year low. And also the hydrological balance is quite weak at the moment. I mean, for the map is showing the hydrological balance, and kind of the red, orange, yellow that is kind of below normal levels. So we see, for instance, then in France, then it's in France, Norway, Italy. I mean, we see also kind of in the Alps is starting to turn kind of be lower than normal years. So we're not getting help from low emission sources like hydro and nuclear availability this year. Of course, that's kind of to do the upside that we see increase in power sector emissions. I mean, we also see that industry, and I guess Nick we can kind of discuss this later as well, but that industry is facing a tough time with high energy costs, high gas costs. So, of course, there are industry sectors that are struggling now with this new or this environment that we are on, reducing production. And of course, if we see then a further kind of further economic downturn, that would also kind of hit industry, and then of course then result in lower industry emissions. But all in all, we see kind of that like emission-wise, currently we see kind of that the increase in power sector emissions is outweighing kind of the decrease in industry emissions. I mean, we also for the on the policies taking more the center stage than it has been doing for some time now. I mean, we have the Fit for 55 package that is kind of adjusting all the legislation in order to meet this new 2030 target. And the Fit for 55 package, or kind of the proposal from the European Commission, was published last summer. But of course, now we see these kind of policymakers have been working on this file, but it's first now that we see they're kind of getting to being kind of voted on, and we see kind of the positions are being more cemented from various in various policy for various policymakers. I mean, first out was the Environmental Committee that we had the 17th of May that we had the vote on the ETS file. Of course, in last summer, the European Commission came out with all these nice little pieces in the puzzle, how they saw kind of the puzzle should fit. But now we see all this altering of the pieces. So the Environment Committee voted in favor of increasing the burden of the EU ETS, limiting the market access, tighten Article 29A, so that's kind of the possibility to intervene in the market when prices are spiking. So also changes to the ETS2, the MSR threshold, market stability reserve thresholds are lowered. So it's really kind of all these pieces now that is changed. Of course, there are kind of other pieces than this, but this is of course kind of going to change the picture slightly for the kind of final picture in the end. Next week we will see the European Parliament plenary vote, and then we will see how much of these elements that will kind of survive from the from the ENVI committee. So I guess kind of it will be interesting to watch kind of the ETS burden, especially in kind of these limiting access to market participants. For the member states, I mean, European Parliament is one side, and then the member states with the Council need to agree on their position, and we. It might be that we will get kind of their kind of positions from the environmental committee or environmental council in end of June. So maybe we'll have kind of the council positions already then in end of June. That means European Parliament and the member states or kind of the council then can start this trilogue negotiations with the European Commission. So we believe that that will kind of intensify or kind of take place over the summer break. But then kind of this was scheduled, but then we had this the Repower Plan coming in from the sideline, which is really kind of the Europe's response to the Russian invasion of Ukraine. Of course, I mean, the war in Ukraine really kind of show how dependent EU is on Russian fossil fuel. So this Repower Plan is kind of the plan to rapidly reduce the dependency on Russian fossil fuels. And of course, the answer is to fast forward the green transition. And on the 18th of May, the European Commission came out with this plan, a set of kind of on how can we do this? I mean, it's proposing to increase the renewable target, the energy efficiency target, reduce the permitting plan for renewables. And it was kind of set of measures that they proposed in this plan. And of course, that requires quite a lot of investment if this is to take place, estimating 300 billion euro investment that is needed. The surprising part was that they proposed to take 20 billion of the grants should come from the Market Stability Reserve. So the Market Stability Reserve, I mean, it's not a tool that was supposed to kind of be used for funding like different things. But what is proposed is that 20 billion should be taken from the Market Stability Reserve and brought to and be auctioned to the market. So then how many allowances that will be auctioned will then depend on the auction price. Of course, if we have the average auction price of 100 euro per ton, then it will be 200 million EUAs that will hit the market from like this extraordinary measures. If it's 80, then it will be 250 million. If we have a price of 50 euros, that means 400 million tons need to be auctions in order to meet this 20 billion the 20 billion target. So, of course, this is a big uncertainty now for the market. I mean, the Market Stability Reserve has really been the superhero of the ETS. EU ETS was really kind of the one thing that brought confidence back in the EU ETS as a climate tool. And now you're starting to kind of play around saying, well, it's working, right? But it can also provide this additional funding. Of course, we have to be like, we all know that we're in an extraordinary situation. I mean, the war in Ukraine needs extraordinary measures, but it's kind of the Market Stability Reserve, the tool to kind of partly kind of should solve this issue is kind of then now kind of discussed. So the proposal is controversial. I mean, we have seen there are member states that are opposing this, that Market Stability Reserve should be used for this this funding purpose. But overall, I mean, I guess from yesterday's council meeting, it was kind of that the overall support for at least the overall Repower Plan. But this will probably be more discussed than in end of June in the council meetings than in end of June. So then we will see kind of a bit more details on how the support is for such a measure. Okay, so yeah, we have done some, before I end, I should probably just say that we've done kind of a bit on modeling on the Repower Plan. Of course, this is bringing supply to the market, but and then you could kind of almost call this as a demand shock, that you put in extra allowances to the market, but then you have the market stability reserve that is responding to these demand shocks again. So it will actually start taking out more allowances than already, because in this modeling exercise, we've estimated the average price, or use kind of the average price of 80, so 250 additional allowances will hit the market up till from 2023 and up to 2026. But then you will see kind of already from 2024 that the market stability reserve will work on this additional surplus and will remove kind of these surplus allowances that are brought to the market. So in overall, we see that the market balance is actually getting, like yearly market balance is getting tighter by the year, when the market is actually already quite tight, because we have implemented the new Fit for 55 package, kind of with the one-off rebasing, steeper linear reduction factor. And it is in these years that you will kind of see the market stability reserve is actually responding, also kind of working on this additional surplus. So we see kind of an overall tightening effect, actually, slightly tightening effect over phase 4. And we see that these kind of emission reduction target, or that the market is tighter in the end of the phase compared to kind of the beginning of the phase, that will kind of mean a higher price response towards the end of the phase. Of course, we assume kind of a long-term horizon on market participants, and I guess we can discuss also if and of course there could be non-neglectable price reaction to the downside if it's implemented. But this will be quite interesting to watch, follow the further discussions. So I guess it's over to Nick. Industry's perspective, then that's going to be quite interesting to see how is European industry coping with the high input costs, and what is the best way to spur emission abatement from industry. So over to you, Nick.
Thanks, Ingvild. And indeed, yes, just floor is yours, Nick.
Thank you, Anders. Thanks a lot. It's I want to thank you for having me here, and the presentation by Ingvild was really interesting already. The position I'd like to take is exactly to provide the industry perspective, whether now is the right time to push for higher emission targets, emission reduction targets in the EU, and whether the ETS and the CBAM are in fact part of the solution. Now, my answer to this is that it is important to take an ambitious line on climate policies, but the way Europe's currently approaching this is counterproductive, and unfortunately is actually contributing directly to a net increase in global emissions. Our company produces primary aluminium in Greece. Aluminium production is very electro-intensive. That means most of our emissions, roughly 80%, are indirect, as we call them. That they come from the electricity that's consumed during the process. So I'm going to focus on those during my presentation, but I would be happy to discuss also direct emissions afterwards. As a result of the efforts of the industry and the ongoing greening of the grid, aluminium produced in Europe has a 50% lower carbon footprint than the global average, and 3 times lower than the footprint of aluminium produced in China, which is currently responsible for roughly 60% of the global output. And it was less than 10% only 20 years ago. Now, despite this difference in carbon footprint, but thanks to the complete absence of a solid link between industrial and climate policy in Europe, over the past 15 years, we've witnessed an impressive erosion of local aluminium production. What you're seeing is a map of the smelters that existed 15 years ago, and the green ones are still open. Now, this disastrous phenomenon has worsened during the current energy price crisis. We've observed the curtailment or shutdown of another 50% of the remaining primary aluminium capacity in the EU. So no new smelters have been opened in the meantime. And all production that shut down, plus all production required to cover the almost tripling of global demand, has been and is being directly replaced by production in other countries like China, Indonesia, where the vast majority of smelters are hooked up directly to coal plants. Now, let me make this clear. Each ton of primary aluminium production lost in Europe leads to a net increase in global emissions by roughly 6 to 12 tons CO2. Now, since September, we've lost roughly 1 million tons of aluminium production in Europe, and through this, we've essentially contributed to, or at least allowed for, an increase in global emissions by 6 to 12 million tons CO2. By the way, just this morning, Reuters was reporting that since the recent shutdown of EU capacity, China has turned into the world's largest aluminium exporter. Now, the current debate is whether we should further raise European targets, pushing CO2 prices further up and phasing out or even eliminating carbon leakage measures. Now, this approach almost presumes that we're operating in a silo or that the market for commodities isn't global. The proposal is to raise ambition, sometimes even beyond the boundaries of actual technological evolution and progress. Now, if this is materialized, then we're sending European production to its doom, and we're actually offering a very poor service to the fight against climate change, despite good intentions. So more specifically, the recent ETS and CBAM proposals seek to gradually or instantly terminate carbon leakage measures, depends who you're asking. Now, this would increase the cost of producing aluminium in Europe by a staggering 50%, without definitely it being possible to pass on this cost to consumers, because this is a price taker industry. This would lead to the closure of Europe's remaining aluminium smelters. Now, people in Brussels often ask me, is this the direct result of CO2 costs? Can we call this carbon leakage? And my answer is, what difference does it make? How you call it? Carbon leakage is not a cause, it's the end game. When you have an incredibly rising global and European demand for a product, a commodity like aluminium, and you witness zero investment in new capacity, plus closures in Europe, namely in a region where production is climate supreme, but it is actually happening, this investment in other parts of the world with a higher carbon footprint, then it doesn't matter what we call it, it's bad for the climate, and we're helping or allowing for it. Now, unfortunately, the CBAM isn't an answer either. This is an illustration of, the left graph is an illustration of what the Commission has or would like us to think the CBAM would do. Now, European producers face carbon costs for their entire production. With the current ETS price, the CBAM proposal would translate in roughly 850 to 900 euros per ton increased cost, extra cost for a European smelter. On the other hand, a similar smelter, let's say from Iran or Dubai, shipping, let's say 10%, that's a high percentage, but let's say, for argument's sake, 10% of its production to Europe, would face an overall production cost increase of roughly 20 euros, maybe 30 euros per ton aluminium. Absorbing this cost, this extra cost, while displacing European competitors from all over the world, including within the EU, shouldn't be such a huge blow to them. Now, coupled with the European institutions' refusal to work on an export solution, the above hypothetical example becomes a certainty. Now, most importantly, for electro-intensive sectors, if indirect emissions are included in the CBAM and indirect compensation stops, then this would lead to an absurd situation where an aluminium producer in Europe, even consuming 100% decarbonized electricity like RES or let's say nuclears, would face massive carbon costs, way higher than those faced by dirtier imports. That's because of the way power prices are set in Europe, the marginal pricing system, as we usually call it, which means that the entire pool of electricity on the market contains an implicit carbon cost. Not to mention circumvention of the CBAM, legitimate or not, well, through actual resource shuffling or maybe through shady greenwashing or the use of unbundled geos, the list is non-ending. This would allow third country producers with dirtier production to keep CBAM costs even close to zero. Now, If Europe wants to get serious in tackling climate change, it should be looking to boost the low carbon production we have here and to make it as globally competitive as possible. This would reduce the need for carbon intensive imports while demonstrating to our trading partners that the path that we have picked can go hand in hand with competitive and sustainable industrial production, and over time leading to a significant decrease of emissions at the global level. That's the only thing that matters anyway. Because right now what they're seeing, our trading partners, unfortunately doesn't provide for a very compelling role model. Now, is the ETS the way to do it? I would argue not. Let's look at the past and maybe allow it to teach us. How did the power grid reach these levels of decarbonization since 2000? Was it the ETS, which only began sending powerful signals, market price signals in the summer of 18? Or was it perhaps mostly due to the support for RES, positive measures, not always well designed, sometimes extremely lucrative? Still, once we helped RES mature and reach market parity, the ETS did begin providing a switching incentive, not before. Now, the belief that constantly pushing CO2 prices upwards renders decarbonization investments, in many cases investments that are not yet available, feasible and economical, is a common misconception and a simplification which unfortunately disregards on the ground reality, and very importantly, it disregards the global nature of these product markets. I'd like to finish on a positive note, suggesting that if we act now to reverse this trend, actually reversing carbon leakage, we could make a difference. It's not a lost cause. And tackling first the challenges faced by electro-intensives makes a lot of sense, because these are the front runners in electrification. If we manage to go green and increase our competitiveness rather than shut down, the carbon-intensive sectors like cement, steel, and so on will follow in our footsteps. And facilitating the cost-effective consumption of renewable electricity by electro-intensives through smart support for renewables PPAs could be key to that. One proposal is what the Greek industry and government are pushing for. That's called the Green Pool. It's already been notified to the Commission. It's being supported by Eurometaux and European Aluminium. And I think it would provide for a decent response to that. Thank you very much. I'd be happy to take some questions afterwards.
Anders, I think you're on mute.
We still can't hear you, Anders. Right.
Maybe in this case, we continue with the investor's perspective on that. And later on, we, of course, go to Q&A on the panel side. So thank you, first of all, for the chance to join this panel and for the fantastic presentations by Ingvild and Nick. In my presentation, I would like to cover 3 points. The first is, of course, the market environment. The second point, investor flows, speculation. And the third is the political reaction to the current discussion and the challenging times. If you look into the market environment during the last couple of weeks, we can basically say that after a significant jump in carbon prices during 2021, we're more or less range trading and trying to find a new kind of fair value in the current environment. You could say we're in price discovery mode, and it's maybe similar to what we witnessed during 2019 after the significant jump in prices 2018, the reaction of the implementation of the market stability reserve. So people try to digest the changed macro conditions, energy prices, what is the impact, of course, on industrial production, on growth, and based on that, we're in price discovery mode. Trading between 80 and 90 euros at the moment, more or less. Energy prices on the one side, and Ingvild had shown the fuel switch prices, are of course supports to the current price environment. Power emissions seem to increase. On the other side, on the negative side, you have the economy that creates concerns. If you look at the impact assessment from the Commission from July 21, you could say we're basically trading in this policy range. 60 to 85 was mentioned in the impact assessment, and that prices where we are trading at the moment reflect the fundamentals and the expectation of future scarcity. The development of speculative positions, so if you look at the commitment of trader reports, you could say that these positions by investment funds reflects this price discovery. I mean, net positions are well below the peak of last year, and as well below the levels that we have seen beginning of the year. And so I think this reflects very much this uncertain kind of price patterns on this side. The main difference, and when people talk about investors on this side, so the main difference that happened last year was the advent of mainstream investors, of ETFs, and so on, retail pension funds that were looking at carbon markets, were looking at the European emissions trading system, and as well investing on that. So why did investors look into the EU ETS? Of course, there were discussions on sustainable finance and ESG in general, that these kind of discussions helped here. People were discussing that investors would like to hedge carbon risks, or were looking for Paris-aligned assets on this side. So I'm sure this discussion took place, but I think ultimately the main point why investors invested into the EU ETS was the macro story, the fundamental story, the Fit for 5 package, the scarcity that is expected, and then as well the momentum. I mean, we had this momentum, the price development during the first half of 2021. And then, of course, momentum creates momentum. And with that, you had a significant increase in carbon prices during 2021. And that basically created an interest from investors. But still, one of the main factors was, of course, the development of energy prices. And investors didn't create a trend. The trend was created by policy, by energy prices, by fundamentals, and they possibly increased the speed of this price adjustment, that we were going from, let's say, a normal price development to the future scarcity price development that was as well envisaged in the Fit for 55 package on that side. But clearly, and I think that's as well, if we look at development of assets under management, for example, of the global carbon ETF from Crane, or as well of other investors, what we have seen is that assets under management have dropped. If we look at around March, in this Crane ETF, there was 35 million tons assets under management. Now this has dropped to 25 million. And of course, many factors are here at play. Maybe people look at this market access discussion and this provided concerns, but more likely it was just that it's not perceived a one-way street anymore, and people just took profit in the current environment as there's too many other uncertain factors here. So missing momentum is possibly the main reason for the reduced assets, or the reduced inflows or more outflows of these investments. And again, when people say, oh, the impact of mainstream investors, if you look at now 25 million tons assets under management and compare that to the TNAC of 1.4 billion, then of course this amount is small to make a trend on this side. Maybe it's as well a factor that people don't believe that carbon is underpriced anymore. If you look at the impact assessment and all these kind of factors that where the analyst forecasts that were provided a year ago, 18 months ago, with the proposal of the Fit for 55 package, you could, of course, clearly argue that carbon in a spot market was underpriced, and therefore people took that decision. Now we trade in this, I would call it the EU policy range between 60 and 85 around this kind of levels, and therefore people take note of that, and of course, will adjust their positions on that side. So I think that is a clear factor. But of course, we are in very challenging times. I mean, if you look at development of energy prices, Inflation is picking up. And of course, this creates concern about competitiveness. And I think Nick made this point very clear with direct and as well indirect emissions and costs for that. But of course, as well, the social cost that comes to people, especially low income on this side, and the impact that fuel prices for heating and so on will have on that. And that creates, of course, pressure on policymakers to do something to soften the burden on the people here in this side. And we can observe that if you look into the policy discussion. If you look at the potential delay of ETS2 as one of the factors that is happening. If you look at the Repower EU package, all this kind of policy discussions reflect that, and clearly the potential auction of additional allowances then creates or is the answer how to finance these kind of measures to soften the burden. The discussion on market access is of course another example, and I think it reflects the view by some policymakers that EU carbon prices were trading in a speculative bubble, and this is an artificial level. Obviously, I don't agree with this point, and I think the main drivers are fundamentals, but I think that clearly represents this view. I mean, if you look as well at the study by ESMA or the documentation provided by the ECB, I think it is pretty clear that the market is functioning and prices reflect the reality on this kind of thing. But of course, you have the situation that policymakers try to show action on these kind of things. And I think it's as well important that the work that, for example, ESMA did is only the first step, because of course more information is required. I think the value of ESMA is to have better data quality and as well broader data, so that we can actually, and policymakers can actually look into what's driving the market. Is there an issue? And once they define that there would be an issue, what is the right policy instrument to tackle these kind of issues on that side? From my perspective, the market access restriction is clearly not the right answer, because it possibly, A, doesn't deal with speculation, because clearly no hedge fund would ever buy physical allowances. At least I have never seen it. They invest in futures, and with that regard, they're not tackled by this kind of perceived issue. The other factor is dealing with the unintended consequences by such a rule. And I think the good thing by ESMA was as well to point out what are commercial banks actually doing on this side. And they provide markets to compliance companies to hedge their exposures. If banks are not there, then compliance companies, industrials would need to buy on a spot basis because they couldn't buy on a forward basis anymore. And that would, of course, require significant financing from that side, and possibly financing that is currently needed to deal with the transition, to invest in low carbon technology and so on. So therefore would have negative consequences for industry. And I think the third point, if you look at the second paragraph of this proposal, where you basically say, or where it's said, if I remember correctly, that the regulated entity could mandate a third party, that's of course an interesting idea, but ultimately how industrial companies work is that they typically ask 3, 4, 5 banks when they need a price, get then the best price, and then execute with that counterparty their hedge on this side. If you would have only one counterparty, you would obviously have monopoly prices because they couldn't go out to third parties anymore. And that, of course, is as well not in line with the, let's say, best prices on these kind of things. With regard to the repower, just 3 quick comments. I think clearly it reflects just the need that financing is needed to cover the costs of, to deal with the increased social costs. And lack of a different way, this was then the route chosen on this side. The issue was, of course, communication. I mean, it was leaked through the Financial Times, and then, so let's say maybe a better way of communicating this would have been important to avoid that trust gets lost on this kind of proposal. And I think possibly it should have as well noted and restated that the cancellation, which is due in a couple of, I think 2024, if I remember correctly, of the, let's say, surplus allowances in the market stability reserve is taking place, and therefore the fear of some people that, let's say, this opens the honeypot, and whenever there's something new, then this MSR will be used to create additional finances will not be needed. To conclude, I think we're currently in a price discovery phase and trade in the range, looking for what will be the driver on the upside or the downside. Investors have captured the trend, have let's say, played a role, but not the key role. The price reflects fundamentals and the trust in the EU and the EU climate policy. And the discussion on speculation was expected, but the market access proposal provides the wrong direction and would have significant negative consequences from my perspective. Thank you very much.
Thank you a lot, Ingo. A lot of very interesting insights there. As you can see, I joined Ingvild in the other room. We had some slight difficulties, technical difficulties on my computer. But we'll switch to the panel session now. It will be a little bit shorter than we had planned. But you have both of you, or all three of you, covered so much already. So I think that's fine. We have quite a few very good questions from the audience also. We won't have time for all of them, but actually, let me start now by the polling question. This one goes out to all you in the audience. We have already mentioned the proposal on banning financials from holding accounts in the Union Registry. And as Ingo pointed out just now, it's something that will obviously, target the trading of physical EUAs rather than futures. So it might not even be that consequential, but still it draws a lot of attention. And now that we are just 1 week from the vote in plenary on the ETS reform package, we would like to ask you very quickly if you think this amendment will actually pass in plenary. So if you can just take a few seconds to answer this. It will be interesting to see what is the view of the people listening in. Give you a few more seconds. Yeah, I guess we can go to the. So we see that 23%. Expected will pass, 77 expected will be voted down. And I mean, a quick reminder, I think it was rather narrowly passed in Envy with the votes of Renew and EPP, obviously. The original proposal coming from an EPP representative in the industry committee. So it will probably need that same constellation to hold also in plenary. But okay, we shall see next week. I wanted to actually use this to get back to you, Ingo, but I think since you already covered it quite well, I'd rather put the question to you than Nick. This whole idea of banning financials or speculators, it seems from the politicians that it's meant to, address a perceived problem of too high prices, and that it's presented as a way to come to the rescue for industry. Is that a view that you share? I mean, is it something that you have asked for or the metals industry have lobbied for? Or is it something that maybe serves a different purpose?
Well, I would say, thanks for the question, Anders. I'd say that the industry is also split on this. Personally, I believe that the more liquidity you have in a market, the more well-functioning it is. So depriving liquidity from a market so long as you're willing to accept that it is a market and that you want to actually see the impact, the price signals from that market rather than predefine them, you should allow for financial participants in any market, and removing them would actually remove a hell of a lot of depth from the market, which would only have a long-term detrimental effect to the efficiency of the functioning of the market. I think it's rather short-sighted to try and remove one segment of that market in order to achieve a desired result, rather than check whether or not pushing constantly higher the price of CO2 of the ETS through policy making and constantly raising the targets. That would probably be more efficient from where I stand.
But I mean, and this is maybe for all of you, if it's not really a push from industry, or at least not the wide range of industry, who is really behind this proposal? Could it be more about political posturing than actually meeting?
I'm inclined to believe that this is probably what's behind it. I mean, people are reacting to, and I think Ingo alluded to it earlier, to the situation that we're seeing over the past, I think Ingo probably mentioned it too, the situation that we're witnessing over the past months or so, these spikes and upward trends and so on and so forth. People feel uncomfortable when the markets produce those results, even when those results are the outcome of market functioning rather than anything else. So they try to tackle it. We've seen it in the electricity markets as well, where we have the marginal pricing system with its flaws in terms of its structural competence to fit the new paradigm where RES is going to be dominating the electricity markets. But you do have a lot of government, particularly in the south of Europe, trying to tamper with the rules in the market to actually produce a different result than the one that actually stems from the market, which is right now quite high. Nobody likes such high prices, particularly not the electro-intensive industries, but is the way to address that. Playing around or fiddling around with the rules of markets, I have my doubts. Thanks.
I see we are running out of time, so I'd like to switch also to cover a little bit more in depth the other key proposal that has come up, the sale of EUAs from the Market Stability Reserve. So, I mean, you all touched upon it slightly, but as Ingvild showed in our modeling, logically in the long term, it shouldn't really have that much of an effect. But then, of course, the market is not always logic or following the logic that we perceive. And there might be psychological elements here. So what is your view of this? Should we see this? Or, I mean, to the extent that it is driving prices, have we seen it, delivering that already? Or should we expect more price movements from that particular proposal? I don't know, maybe you want to start, Ingo, on that?
Yes, of course. Well, look, I think the initial reaction was quite steep, but possibly as well in a sensitive week. I assume that the important thing now to watch is, will this actually pass? Because ultimately it's a proposal and needs to be approved by Council and by the member states on this side. So, I mean, depending then on your future emissions kind of modeling, you will come to a conclusion that it is like reverse backloading. You take something out and then it's more or less, let's say, supply neutral. Or I think other analysts model it that it will have a, let's say, reduce supply overall on this side, possibly depending where are we in the supply bands going forward. I think at the end of the day, it will have an impact on back of liquidity in the short term. I mean, if you auction additional volumes, it will have an impact on the market price because there's more supply. And that we've seen as well in other cases when backloading also something like happened. But of course, that should then, let's say, counter, or the reduced auction supply in the future will then counter this in the long term. So maybe on a phase 4 average price level, it's possibly neutral. But it clearly will have an impact on the short. If it passes, it will clearly have an impact on prices because there's just more supply coming to the market.
Right. Thank you. I think now is maybe then the time to take a few questions from the audience. I see we have received several on the timelines, both for the ETS reform process and the Repower. Maybe you want to start, Ingvild, on what we think could be a likely timeline?
Well, I mean, for sorry.
Sorry. No, I think kind of the trilogue, I mean, we expect the trilogue for the Fit for 55 to start kind of after summer break. Of course, how long it will take before kind of they land the final proposal, but that it will at least kind of, or could kind of prevail until kind of beginning of 2023. That could be the case. It's a big package. It's a lot of pieces in the puzzle that needs to be fitted together. And of course, we don't know too much about kind of the member states, kind of the council positions out as yet, of course. So it depends a bit on how far away they are from some of the key elements from the parliament. So if they are kind of look similar when they start and negotiate the trilogue negotiations, then of course that will kind of make it easier way through the trilogue. But of course, I mean, at least kind of looking from past experiences, that this is it takes time. So that we could kind of perhaps see that we need to go into 2023 before we have the final position. That might very well be. And then it's also kind of getting into kind of how fast can it be then implemented and then put into legislation as well. So, I mean, in our base case, we have 2025 as implementation. Of course, that could be 2024, but 2024, 2025, that's kind of the yeah.
Yeah. I think probably also if we remember back in the review for phase 4, I think the original proposal came out, was it in 2014, and it took till late 2017 to finalize it politically and then implement it in 2018. So if we go by that timeline, it's still some time to have it finalized.
And I think we also saw that from the Commission proposal as well, that this kind of rebasing, I mean, they foresee when kind of in the impact assessment, they kind of foresaw kind of 2024, but kind of opening up kind of that will kind of be lower if you start in 2025, and of course kind of adopting a linear reduction factor, or not adopting, but proposing a linear reduction factor that is regardless of when kind of the implementation is happening. But of course that will mean something to the market, because of course the later you start, the more supply has already hit the market. So that's even though kind of that one-off rebasing will be larger if you delay it with 1 year.
Any comments, Nick, on the timeline from your perspective?
I'd just like to say, yes. I'd like to just say that for the industry, the discussion on the ETS timeline and the CBAM are directly interlinked. So this is something that policymakers sometimes tend to remember and sometimes tend to forget. We've witnessed in the past few weeks some weird, even contradicting views taken. The example of indirect emissions is one of them. I mean, you had the ENVI vote, where indirect compensation in the as far as the ETS is concerned should be maintained and actually encouraging member states to adopt it all the way through to 2030. However, discussing in the CBAM file that indirect emissions should be in, which would in turn terminate prematurely indirect compensation. So there are some issues that I fear haven't been grasped, but I think the delay in the ETS approval or reform will have a lot to do with how member states actually perceive the CBAM impact as well. That will be really crucial as far as phasing out free allowances and indirect compensation is concerned. So these two are tied together. But it is interesting, if I have 1 minute, maybe to discuss the repower that you mentioned and the timeline on the repower. The repower isn't really a full-fledged legislative proposal, right? It has a few pieces of legislation in there, like the RRF proposal, the regulation for the amendment of the RRF regulation, and the RED as well. We're reviewing the RED as well. Now, for the EED, for instance, you set a higher target, but you don't submit as Commission a proposal to review the EED proposal that you've already submitted. It's so I'm guessing that the higher energy efficiency target will just be the way that the Commission comes into the trilogues. And then you have joint purchases of LNG and the storage obligations and the MSR injection, but those are not really legislative proposals in the strict meaning. So the way it will go, I think, is that the Commission will try to push as much of it as possible through, communications and stuff like that. And the pieces of a repower that will actually be part of the trilogues are quite limited, in fact.
Thanks. Ingo, any more comments on the timeline? I guess you already touched upon some of the things happening shortly, but...
Look, I mean, just a quick comment. I think this Fit for 55 package would have been a huge policy package even in normal times. Now with the challenges around, it's obviously much more, creates much more work on this side. So I think we all hope that there would be an agreement in the ENVI Council in June. That would give the possibility that the trilogue would start after the summer break. And then it will take as much time as it needs, depending, of course, how different the proposals will be and how much time is required to compromise. I think the key thing is that it gets approved by end of 23, because you have parliament elections in 24. And from that perspective, that is obviously a key timeline. But let's hope that everything gets agreed on the council side until in June. And then that would provide sufficient time.
Indeed. This has been an interesting discussion, and we have still plenty of questions, but I think we have to respect the time allotted to us. So I think we have to end there, actually. We'll try to get back to you as much as we can with the questions that we didn't have the chance to deal with now. I'll just remind you there will be a survey at the end of after this last slide, I believe. And maybe also just 2 words to highlight that we are shortly about to present a new price forecast, long-term price forecast, as well as our carbon market survey, which I think will come out later today if it's not already out. So look out for that on Icon. So with that, I say thank you to Ingo and Nick and Ingvild and the audience, and have a nice rest of the day. Thank you.
Thank you very much. Have a good day.
Thank you.
Have a good day. Bye-bye.